Welcome back to the deep dive. Today we are tackling something that it feels like the ultimate paradox. For some people, it's this glittering casino where you put in a coin and, pull out a Ferrari.
Hmm.
For others, it's just this terrifying black hole that eats retirement savings. But usually when people talk about it, they always talk about the upside.
It's the place where fortunes are made. I mean, that's the marketing pitch, isn't it? But let's be honest, it's also where they're sometimes lost just as quickly.
Hmm.
The allure is undeniable wealth creation,
Right.
but the reality check is always risk.
Exactly. And that tension, that wealth versus risk dynamic is exactly what we're unpacking today. But we aren't just talking about stocks in a general sort of cocktail party way. We're getting very specific.
Very specific.
We are doing a deep dive into Chapter 8, Investing in Stocks for the NISM Series-X-A certification.
Right. And if you're studying for the exam, you should really consider this your audio companion. We're going to decode the textbook talk, line by line, and make sure no concept is skipped. And I'll be specifically flagging items that I think are likely to pop up on the exam.
Okay.
But even if you aren't taking the test, this is, well, it's arguably the most important chapter for anyone wanting to understand how the Indian equity market actually functions under the hood.
And I'm playing the role of the eager student today. I've read the PDF, I've got my highlighter out, but there are parts where the financial jargon gets a bit thick. So I'm really relying on you to translate this textbook talk into, real world Indian market understanding.
That's the plan. And we have a lot of ground to cover. We need to define what equity actually is, look at the risks, because there are way more than you probably think.
Mm-hmm.
Then break down fundamental analysis using the EIC framework, and then wade through that whole alphabet soup of valuation ratios like PE, PEG, and EV/EBITDA.
And then the charts.
And finally, yes, we'll touch on the quote-unquote dark art of technical analysis.
So let's start at the very beginning. Section 8.1, Equity as an Investment. The text starts by distinguishing between equity and debt. Now, to me, this seems kind of basic. One is borrowing, one is owning. But how does the text strictly define it?
It defines it through the lens of the claim on the company. So when companies need capital, they basically have two main choices. They can borrow money, which creates debt securities, or they can, give away a piece of the company, which creates equity securities.
Okay, let's put this in an Indian context to make it stick. If I put my money in a fixed deposit at, say, HDFC Bank, what am I doing?
You're lending money to the bank. You are a lender. You hold a debt instrument. You get a fixed return. And strictly speaking, you don't really care if HDFC makes ₹1 billion profit or it just breaks even.
As long as I get my interest.
As long as they pay your interest. You have no say in how the bank is run, but you have security.
But if I buy a share of HDFC Bank on the NSE?
Then you are an owner. Simple as that. You're holding equity. You are now a partner in the business. And as a partner, your returns are not fixed. If the bank does well, you do well. If the bank fails, you suffer.
The features differ completely because the claim on the company differs. And this brings us to a massive keyword in the text. I mean, if you have a notebook, you should probably write this down. Residual claim.
Residual claim. It sounds like something left over in a chemistry experiment, doesn't it?
It does, but in finance, it's a legal definition, right?
It essentially is what's left over. The text explicitly states that equity shareholders have a residual claim on the business. And I want to flag this right now as a high probability exam question regarding the definition of equity. It means you get paid last.
Last. That doesn't sound like a great sales pitch for stocks. Invest with us and we'll pay you last.
It's the reality. It's the hierarchy of claims. Imagine company goes bust and has to be liquidated. Who gets paid first?
I'm guessing the government, taxes and all that.
Always. The government gets their taxes, then the employees get their salaries, then the vendors who supply the raw materials, then the lenders, the bondholders, and banks. Only after everyone else is satisfied, if there's anything left, the residue that belongs to the equity shareholders.
So if the company owes, say, 100 crores to lenders and only has 90 crores in assets, the shareholders get zero.
Zero. You get wiped out. That is the risk.
So, because we take the biggest risk of getting nothing, we require the biggest potential reward.
Precisely. That is the risk-return trade-off. And the text notes that because shareholders are not contractually obligated to receive any payment, there's no guaranteed dividend, no guaranteed repayment of principal, they expect a return significantly higher than debt investors.
Okay, so besides the potential for capital appreciation, the stock price going up, and maybe dividends, what else do I get for being last in line?
You get a voice. Equity investors get voting rights. You can participate in the management of the business, usually through AGMs, the annual general meetings.
Right.
Debt holders, like people with bonds or FDs, they don't get a say in how the company is run. They just want their interest. Shareholders can vote on mergers, on appointing directors, on dividends.
Right. So the student in me asks this. If equity is so risky, why would anyone choose debt? I mean, if all the long-term data shows stocks win, why ever buy a bond?
It all comes down to risk appetite and your time horizon. The text makes a really clear distinction here. Investors who desire lower risk choose debt, but at the cost of lower stable returns.
Like someone who's retired.
Exactly. Maybe they're retired and need that monthly income. But if you're seeking higher returns to beat inflation and actually grow your wealth, you must choose equity investment. However, and this is the key, you may not be able to earn it without taking on all that additional risk we just talked about.
Which segues perfectly into Section 8.2, diversification of risk. The text mentions that old adage, don't put all your eggs in one basket. But then it gets technical with cross-sectional versus time series diversification. These sound like statistics terms.
They are, but the concepts are actually pretty intuitive. Let's break those down. So cross-sectional diversification is what most people think of when they hear the word diversify. It means holding different kinds of businesses at a single point in time.
So not just buying Infosys, Wipro, and TCS.
Exactly. I mean, if you only own IT stocks, you have what's called concentration risk. If the US dollar crashes or AI replaces coders, your whole portfolio just sinks. Cross-sectional diversification means you own some IT, some pharma like a Sun Pharma, some banking like SBI, maybe some auto like Tata Motors.
You're spreading the risk across different business sectors and industries.
You are, and the text even cites empirical research here.
Oh yeah, what does it say?
Well, it shows that this significantly reduces risk because these sectors don't always move in lockstep. Sometimes banks are up when pharma is down. They are not perfectly correlated.
Okay, so that's spreading bets across the market. What about time series diversification?
This is about spreading your risk across time. It's the concept of holding equities over a long period. The text implies that the bad times market crashes, recessions. They tend to get canceled out by the good times if you just wait long enough.
This is where that famous phrase comes in, right? Time in the market is more important than timing the market.
Spot on. Reaping the benefits of time diversification requires patience.
Yeah.
I mean, if you buy a stock and you need to sell it next week, your risk is massive. If you can hold it for 10 years, the statistical probability of a loss just drops dramatically.
And underlying this whole idea of time and diversification is the concept of the business cycle. The text asks you to visualize figure 8.1.
Right. So for everyone listening, I want you to just close your eyes for a second, unless you're driving, of course.
Please don't.
Yeah, please don't. Imagine a graph. There's a dark line curving up and down like a wave. That represents the economy. It goes through peaks, which is expansion, and troughs, which is recession.
And different businesses ride this wave differently.
Exactly. We have cyclical businesses and countercyclical, or what they also call defensive businesses.
Okay, can you give me an example of a cyclical business?
Sure. Think about things you buy only when you feel rich or confident about the future. A new car, a luxury apartment, new heavy machinery for your factory. These are all cyclical.
So auto stocks, real estate, capital goods, things like that.
Correct. They tend to peak when the economy peaks, and they crash hard when the economy slows down.
Yeah.
I mean, if people are losing jobs, nobody's going out to buy a new Tata Safari.
Makes sense. And the countercyclical or defensive ones?
These are things you buy no matter what the economy is doing. You still brush your teeth, right?
Hopefully.
You still need medicine if you're sick. You still pay your electric bill.
So FMCG, fast-moving consumer goods, and pharma.
Yes. Companies like HUL or Sun Pharma are considered recession-proof. They might not skyrocket during a massive economic boom because, well, people don't suddenly start brushing their teeth twice as much.
Right.
But they won't crash as hard during a recession. They're defensive.
The text also mentions lead and lag sectors. What's that about?
Yeah, so some sectors recover before the economy does. Those are the leading sectors. Financials often lead because money starts flowing before projects actually start. Others take a while to catch up. Those are the lagging sectors. So understanding where we are in that sine wave is crucial for knowing which sector you probably want to be in.
Okay, moving on to Section 8.3, risks of equity investments. The text lists 6 specific types of risk. Now, the host in me wants to just skip to the fun valuation stuff, But the student in me knows the exam is going to ask, which of the following is not a source of risk? So we have to go through all 6.
You're absolutely right. And honestly, understanding these risks is actually more important than valuation. You can't value a stock if you don't understand what can kill it. So let's list them out.
Number 1, market risk.
This is also known as systematic risk, and it's the risk that affects all stocks. Think of a war breaking out, or inflation spiking across the globe, or the RBI suddenly raising interest rates.
And I can't diversify this away.
No, you cannot. If the RBI hikes rates, it hurts Reliant, it hurts HDFC, it hurts everyone, it hits the whole market.
And the text mentions beta here. Is that important?
Yes, definitely flag beta as the proxy measure for market risk. A beta of 1 means the stock moves exactly with the market. High beta means it's more volatile than the market. Low beta means it's less volatile. But the point is, you can't escape it.
Got it. Okay, number 2, sector-specific risk.
This is one that hits only one industry. A perfect recent example would be the pandemic restrictions. Who got hit?
Airlines, hospitality, tourism.
Exactly. And who was fine?
Software, digital services.
Right. So if you were diversified cross-sectionally, you were probably okay.
So if I held Indigo Airlines and PCS, the risk was balanced out.
Exactly. This can be diversified away.
Okay. Number 3, company-specific risk.
The fancy term for this is idiosyncratic risk. This is a risk that's totally unique to one firm. Maybe the management is committing fraud. Maybe they launched a product that, explodes. Maybe their factory burned down.
Like the classic Satyam scandal in India. That's a perfect example.
Perfect example.
Yeah.
The market didn't crash. The IT sector as a whole didn't crash. But Satyam crashed because of Satyam-specific issues. This is the easiest risk to diversify away. If you own 20 stocks, one going to zero hurts, but it doesn't kill your portfolio.
Right. Number 4, transactional risk.
This one's a bit more operational. It's the risk that the other party in a trade doesn't fulfill their side of the bargain. Maybe they don't pay or they don't deliver the shares.
But doesn't the stock exchange handle all that now?
It does now. The text explicitly mentions that stock exchanges have really robust risk mitigation procedures, like the Settlement Guarantee Fund, to take care of this. But conceptually, it's still a defined risk. In the old days of physical share certificates, this was a huge problem.
Oh, okay. Number 5, liquidity risk. This one is interesting. The risk of not being able to find a buyer or a seller.
Right. But it's not just about finding someone. It's about finding someone without moving the price against yourself. And this brings us to a really specific concept the text highlights. Impact cost.
Impact cost. Okay, let's do a mini deep dive on this. The formula looks a bit intimidating to a layperson, but the concept itself seems practical.
Let's simplify it. Imagine you want to buy an order size of, say, 1 lakh rupees of a small unknown company. The current best price on the screen, the last traded price, is 100 rupees.
Okay, so I expect to pay 100.
You expect to, but there just aren't enough sellers at 100. Maybe there are only 10 shares available at 100 rupees. The next seller wants 102. The next one wants 105. By the time you fill your 1 lakh rupee order, your average acquisition price might be 103 rupees.
So I paid 3 rupees more than the ideal price just to get the trade done.
Exactly. That 3% difference is the impact cost. It represents liquidity risk. For a stock like Reliance or TCS, the impact cost is tiny. It's fractions of a percent because there are millions of buyers and sellers. For a thinly traded penny stock, the impact cost can be massive. You're literally losing money just by entering the trade.
Wow, okay, got it. And finally, number 6, currency risk.
This sounds like it's for Forex traders, but it absolutely matters for equity too. The Indian market is heavily influenced by foreign portfolio investors, or FPIs.
How so?
Well, if the rupee starts depreciating against the dollar, let's say it goes from 83 to 85, those foreign investors are losing money in dollar terms, even if the stock price stays flat in rupees.
So they might just sell to cut their losses.
They might. If the rupee looks weak, FPIs tend to pull money out, and when they sell en masse, it can crash the stock market. So currency volatility bleeds directly into equity volatility.
Okay, that covers the risks. Phew. Section 8.4 is a brief one. Overview of the equity market. It mainly distinguishes between listed and unlisted companies.
And the key takeaway here is just one word: regulation. Listed companies, those on the BSE or NSE, have to abide by very strict listing norms. They have to disclose their financials every quarter, inform everyone about board meetings, disclose shareholding patterns.
And unlisted companies don't.
Not to the same degree. They don't have that same burden of public disclosure.
And this is where SEBI comes in.
Yes, and flag this for the exam. SEBI's primary role here is regulating that listed space to protect investors and ensure transparency.
All right, let's get to the core of the chapter. Section 8.5, Equity Research and Stock Selection. It starts by splitting the research world into two camps, buy side and sell side. What is the difference here?
It's all about who pays the salary. Sell-side analysts work for firms that sell ideas. So, investment banks, brokerages like an ICICI Securities or a Modal Oswald, they're the ones who produce those glossy reports with buy, hold, or sell ratings.
And their goal is what? To make me money?
Ideally, yes. But their primary business goal is to generate trading commissions. They want you to read the report and trade. Their research is public, or at least it's available to clients. It's essentially broad guidance on multiple sectors.
Okay, and the buy side, who are they?
They work for the institutions that actually have the money: mutual funds, hedge funds, insurance companies. A buy-side analyst at, say, HDFC Mutual Fund writes reports only for their internal fund manager.
So I'll never see a buy-side report. Likely not. It's proprietary information. And their research needs to be much more accurate, because if they're wrong, their fund loses actual money. Sell-side analysts can be wrong and still generate commissions for their firm. Buy-side analysts have real skin in the game.
That's a really crucial distinction. Now, let's talk about how they actually pick stocks. The text introduces fundamental analysis.
The holy grail of long-term investing. The definition you absolutely need to know is this. Fundamental analysis is the process of determining intrinsic value based on economic factors.
Intrinsic value? That sounds philosophical.
It kind of is. It represents the true value of the stock, independent of what the market price says today. The trade is simple. If the market price is less than the intrinsic value, you buy. If the market price is higher than the intrinsic value, you sell.
Simple in theory, hard in practice.
Very hard.
And to find this value, the text suggests two approaches, top-down and bottom-up. Right. Think of top-down as using a telescope first.
Wow.
You look at the big picture, the economy E, then you zoom into the industry, and finally you look at the specific company C. This is the EIC framework.
And bottom up.
That's like using a microscope first. You find a great company, fantastic management, amazing product. You don't care as much if the economy is slowing down because you believe this specific company is just going to win anyway.
Let's walk through the EIC framework, starting with E, economy analysis.
So here, you look at the big macro factors. GDP growth, inflation, interest rates, even monsoon forecasts in India. The text highlights a very specific relationship here. The stock market is a leading economic indicator.
Meaning the market moves first.
Yes. The market moves based on expectations of the future. If investors think the economy will recover in 6 months, the market goes up today. It doesn't wait for the official GDP data to be published.
Got it. Moving to I industry analysis, we talked about cyclical versus defensive earlier, but the text has another visual here, figure 8.2, the industry life cycle.
Right, so imagine a curve that goes up steeply and then flattens out. It has 4 stages. First, you have introduction, a brand new industry. Sales are low, profits are probably negative because development costs are so high.
Like EVs a few years ago.
Exactly. High risk, high potential. Then comes the growth phase. The market accepts the product. Sales just rocket up. Competition is still pretty low. This is where the profit margins are highest.
Then maturity.
This is usually the longest phase. The industry now grows at about the same rate as the overall economy. But now, competition is fierce. Everyone is fighting for market share. Margins normalize, which is a nice way of saying they come down because you have to give discounts to sell.
And finally, decline.
Sales drop, margins get crushed. Think of, landline phones or typewriters. Knowing where an industry is in this cycle tells you what kind of growth you can reasonably expect.
Which brings us to C company analysis.
This is where we get specific. It involves both qualitative and quantitative factors. Qualitative is things like a SWOT analysis, strengths, weaknesses, opportunities, threats. Quantitative is analyzing the financial statements, the P&L, and the balance sheet.
Which leads us to the math. Section 8.5.4, estimation of intrinsic value. The text opens with a quote I really liked. Price is a fact, value is an opinion.
I love that quote. It perfectly sums up valuation. It is art as well as science. The science is the math, the formulas. The art is the assumptions you plug into them.
The first model mentioned is the big one, DCF, discounted cash flow.
This is the gold standard for finance academics. The concept is pretty simple. A company is worth exactly the sum of all the cash it will generate in the future, discounted back to today's value.
Why discounted?
Because money today is worth more than money tomorrow. I mean, if I offer you 100 rupees today or 100 rupees 5 years, which one are you taking?
Today, obviously.
All right. To make you wait 5 years, I'd have to offer you, say, 150. That difference is the discount rate. It accounts for inflation and risk.
So for DCF, I need 3 inputs.
Yes. You need 1, the stream of future cash flows. How much money will they make? 2, the timing of those flows. And 3, the discount rate. What is the expected rate of return or the risk?
And what's the problem with DCF?
It is incredibly sensitive. If you just change your discount rate assumption from 10% to 11%, the final value you get for the company can drop by 20% or more. Small changes in your assumptions lead to massive changes in the value. That's the opinion part. That's the art.
The second model is asset-based valuation.
The formula here is pretty straightforward. Value of firm adjusted current market value of assets minus liabilities. It's basically asking, if we shut down the company today, sold everything it owns, and paid off all the debts, what cash would be left?
Where does this work best?
Asset-heavy sectors. Real estate companies, gold jewelers, distributors with lots of inventory.
And where does it fail?
Tech companies. Service firms. I mean, what is the asset value of a software brand or a consulting firm? Their value is in their people and their code, not in factories or land. Asset-based valuation would undervalue a Google or a TCS massively because their most important assets aren't on the balance sheet in the same way.
Okay, now we enter the alphabet soup section. Section 8.5.5, relative valuation. This is what you see on financial TV all the time. The text lists a ton of ratios. I'm going to throw them at you, and you decode them and tell me the exam flag for each.
Let's do it.
First up, the PE ratio.
Price to earnings, the most common metric of them all. It's the market price divided by the earnings per share, EPS. So if a stock is trading at 100 rupees and earns 10 rupees per share, the PE is 10. It means you're paying 10 rupees for every 1 rupee of earning.
The text mentions trailing versus forward PE. What's that?
Trailing PE uses the past 12 months' earnings. It's a fact. Forward PE uses the estimated future earnings. Forward is more useful for investing because markets are forward-looking, but it's based on someone's guess.
Okay, exam flag on PE.
The main thing to understand is that a high PE isn't always bad. A high PE implies high growth expectations. If investors think a company's earnings will double next year, they're willing to pay a high multiple today. Conversely, a low PE might mean the company is in trouble, not that it's a bargain. It could be a value trap.
Got it. Next, PBV ratio, price to book value.
This is the price per share divided by a shareholder's equity per share. It compares the market price to the accounting value of the company.
And when do we use this one?
The application here is crucial for banking and finance sectors. You should flag that. Why? Because for a bank, their assets, which are loans, are marked to market, so their book value is a fairly accurate representation of reality. For a service or tech firm, PBV is much less useful.
Okay. Next, PS ratio, price to sales.
Market capitalization divided by the company's total revenue.
When would I use this?
When a company has no earnings. If a startup is loss-making, like a Zomato or a Paytm in the early days, you can't calculate a PE ratio because the denominator, earnings, is negative. So you look at price to sales. It's also a bit harder for management to manipulate sales figures than it is to manipulate earnings figures.
Now, here's one I see highlighted a lot, the PEG ratio.
Yes, flag this one heavily for the exam. PEG stands for price earnings to growth. The formula is the PE ratio divided by the EPS growth rate. It's designed to solve the problem of, is this high PE justified?
What's the rule of thumb?
If the PEG is less than 1, the stock is potentially undervalued. If the PEG is greater than 1, it's potentially overvalued.
Let's do the math on that.
Okay, simple example. A stock has a PE of 20. That sounds expensive compared to a market PE of, say, 15. But what if that company is growing its earnings at 40% per year?
Okay.
You take the PE of 20 divided by the growth rate of 40, you get 0.5. That's a PEG of 0.5. It suggests the stock is actually cheap relative to its massive growth.
That makes so much sense. It contextualizes the price. Okay, next, EVA and MVA.
Economic value added and market value added. EVA is interesting because it deducts the cost of capital. The formula is net operating profit minus capital invested multiplied by the cost of capital. It answers the question, did the management generate returns higher than what it cost to borrow or raise the money?
So it's about true profit.
Exactly. If EVA is positive, they created true economic value. If it's negative, they actually destroyed value, even if they showed a profit on paper.
Next up, EBITDA.
This is a favorite for mergers and acquisitions. First, you have to define enterprise value, or EV. It's the equity value plus debt cash. It represents the theoretical takeover price of the whole company. Then you divide that by EBITDA.
And why would I use this over PE?
It's much better for capital-intensive industries like steel or telecom. These companies have huge depreciation charges and very different debt structures. EBITDA ignores interest and depreciation, so it lets you compare the pure operating performance of two steel plants, even if one has way more debt than the other.
What about EV sales?
Same logic as price to sales, but it accounts for debt because it uses enterprise value. It's just a more comprehensive version of the PS ratio.
2 more yields to go. Dividend yield.
The formula is simple, dividend per share market price, 100. So if a stock is at 40 rupees and pays a 2 rupee dividend, the yield is 5%. It tells you the cash return on your investment, which you can compare to an interest rate on a bond.
And earnings yield.
This is literally just the inverse of the PE ratio. It's earnings per share divided by the market price. If the PE is 20, the earnings yield is 1 divided by 20, which is 5%. It lets you compare the stock's earnings power directly to a bond yield.
So if a 10-year bond pays 7% and the stock's earnings yield is only 3%, stocks look expensive.
Exactly. It's a way to compare across asset classes.
Section 8.6 is a short bridge, combining relative and DCF models.
Yeah, this just makes the point that they aren't totally separate worlds. Multiples like PE are essentially simplified versions of DCF models. They both rely on the same drivers: growth, risk, and cash flow. If you assume a constant rate of growth forever in a DCF, the formula mathematically collapses into a PE multiple.
Okay, we are shifting gears completely now. We are leaving the world of balance sheets and entering the world of charts. Section 8.7, technical analysis.
A completely different religion. Fundamental analysis, remember, looks at the company, the earnings, the management, the economy. Technical analysis, or TA, looks only at two things: the stock price and volume. The core belief is that you can forecast price based on its history and patterns, not its fundamentals.
The text lists 3 premises of technical analysis. What are they?
Okay, first, market action discounts everything. TA believes that all the news, all the earnings reports, all the rumors, all the economic data, it's already reflected in the price. You don't need to read the news, you just need to read the chart.
Premise 2.
Prices move in trends. Stocks don't move randomly. They follow a direction up, down, or sideways for a period of time.
And 3.
History tends to repeat itself. This is a big one. It's based on the idea that human psychology doesn't change. Fear and greed create the same patterns on charts today as they did 100 years ago.
So in the TA versus FA battle, what's the main difference in philosophy?
FA is for the long term. It's trying to find intrinsic value. TA is generally for the short term, trying to time a trade. A technical analyst doesn't care about value. They care about price equilibrium. They assume the price is always right, and they just try to predict where it's going next based on supply and demand dynamics.
The text outlines a few specific technical rules and indicators. Let's try to visualize them for the listener. First up, trend line analysis.
Okay, listener, close your eyes again. Imagine a zigzag line on a graph. That's the stock price. If the peaks, the tops of the zigzags, are getting higher, and the troughs, the bottoms, are also getting higher, you can draw a line connecting the bottoms. That line is going up. That is an uptrend.
And the opposite is a downtrend.
Right. If the peaks are lower and the troughs are lower, it's a downtrend. And if the peaks and troughs are just bouncing between two levels, it's a sideways channel. The rule is simple: trade with the trend.
Okay, next, moving averages, MA.
Prices are volatile. They jump around every day. A moving average smooths out that noise. A 50-day moving average is just the average closing price of the last 50 days, plotted as a smooth line on the chart.
And the strategy?
It's a momentum indicator. When the current jagged price line crosses above the smooth moving average line, it's seen as a buy signal. Momentum is shifting upwards. When it falls below, it's a sell signal.
And finally, Bollinger Bands. This sounds like a band from the 70s.
It does, doesn't it? It's a volatility indicator. Imagine that moving average line in the middle of the chart. Now, draw another line, 2 standard deviations above it, and a third line, 2 standard deviations below it.
So it's like a channel.
Exactly. It looks like a river with the price swimming inside it. The river widens when volatility is high and narrows when it's low. When the price touches the upper band, the stock is considered overbought. It might fall back. When it touches the lower band, it's considered oversold. It might bounce back up.
The text also notes that technical analysis can be used for fixed income, for bonds.
Yes, bond traders use charts to track yields and prices just like stock traders do. The psychology of a market is the same everywhere, regardless of the asset.
We are at the final section, section 8.8, qualitative evaluation of stocks. We've talked about all the numbers, but this is about the soft stuff.
Specifically, it's about corporate governance. The text calls this the ultimate make-or-break factor. You can have the best PE ratio in the world, the best chart, the best product, but if the management is stealing money, the stock will go to zero.
So what should we be looking for?
The text lists a few things. Accounting standards. Are they aggressive or conservative? Executive compensation? Are they paying themselves millions while the company is losing money? Treatment of minority shareholders. Do they care about the little guy or just the promoters?
It's the foundation.
It is. The text cites Satyam again. Poor governance leads to scandals and bankruptcy. It's the foundation that holds up all the other analysis. Without it, everything else is worthless.
Wow. We have covered a massive amount of ground, from residual claim to PEG ratios to Bollinger Bands.
It's a lot of tools. And that's really what this chapter is. It's a toolbox.
Yeah.
You don't use every tool for every single job, but you absolutely need to know that they exist.
So if you had to give the listener a quick recap of the absolute must-knows for the exam, what would they be?
Okay, quick fire. 1, the definition of equity. You've got to remember residual claim, you get paid last.
Got it.
2, risk. Know that beta measures market risk and it cannot be diversified away. 3, fundamental analysis. The concept that the stock market is a leading indicator for the economy. 4, ratios. Definitely memorize the PEG ratio, rule less than 1 is good. And 5, technical analysis. Understand its core assumption that price discounts everything.
And as we wrap up, I want to leave the listener with that thought from the valuation section. Valuation is art as well as science.
It's a really provocative idea. I mean, think about it. If the math, the science is the same for everyone, why do investors disagree on the price? Why is there a buyer for every single seller?
Because of the art.
Because of the art, the assumptions. I might assume India grows at 8% for the next decade. You might assume it grows at 5%. That tiny difference in opinion changes the value of every single company in the country. The edge in investing doesn't come from doing the math better. It comes from having a better opinion about the future than the person on the other side of your trade.
That is a powerful thought to chew on. Here's my challenge to you, the listener. Pick one stock, just one. Look up its PE ratio. Then look up its estimated growth rate. Calculate the PEG ratio. Is it under 1 or over 1? Try to apply just one tool we talked about today.
That's the absolute best way to learn. Get your hands dirty with the data.
Thanks for diving deep with us today. Good luck with your study for the NISM Series-X-A, and we'll catch you on the next deep dive.
Happy investing.